What do advisors need to know about investing in international stocks? Hi, I'm John Ameriks. Today we'll dive into the forces advisors should consider when evaluating global equity exposure and what valuation differentials may mean for long-term returns. We'll also talk about value versus growth dynamics and how quality metrics factor into our equity approach. Well, I don't think I'm going to surprise anybody here with this, but we don't believe investors should be trying to time international equity markets. Global returns are driven by many forces: currencies, policy, geopolitics, and extrapolating the most recent performance has not historically led to better outcomes. The structural case for international equities is diversification. It's all about reducing reliance on a single economy and gaining exposure to different growth paths around the world, not making a short-term call. There are also real structural advantages, particularly for systematic and quantitative strategies. International markets are broad, fragmented, and unevenly covered by analysts, which creates an environment where disciplined processes can be effective at scale. For some clients, emerging markets can play a role, assuming the risk tolerance is there. And importantly, global trading costs have declined meaningfully over time, making international investing more efficient than it once was. Finally, as trade becomes more fragmented and countries turn inward, country-level investing can become more attractive, allowing investors to be more precise about the exposures they want rather than relying only on broad global aggregates. Well, if I could give you a great answer to that question, I wouldn't be sitting here. I'd be on a beach somewhere retired. But basically, rather than trying to time factor cycles, which is one of the hardest things to do in the markets, advisors are better served by focusing on how factors are defined and implemented. That's especially important because one manager's growth strategy can plausibly be another manager's value strategy. That's an unfortunate reality of how factors are constructed in the marketplace and why clients can benefit from working with a great advisor who knows their stuff. Labels matter far less than understanding what's actually in the portfolio. AI is a great example of where this distinction really matters. Like others at Vanguard, including our chief economist, my view is that for AI innovation to really move past the "is this a bubble" question or phase, we need to see its use start to affect the bottom line across a much broader set of companies, not just the largest technology firms. That's a view that leans more toward traditional value-oriented outcomes, where productivity gains show up across the economy. A more growth-oriented view might be that the largest technology firms continue to scale, gradually subsuming more of these activities themselves. But even in that case, as these firms broaden, earnings growth rates would almost have to slow. The underlying businesses don't change simply because ownership does. Now, I don't have a crystal ball to tell us which story is going to dominate, but my instinct is that we're likely to get some of both, which is another reason why diversification and thoughtful factor construction matter so much here. So, at a high level, our process looks similar to what fundamental analysts do, just at scale. We evaluate companies across many dimensions, including quality, and we compare them systematically, and we form views about which are more likely to perform better over time. Quality metrics are a big part of that process, but they're never used in isolation. We look across multiple signals to build more confidence than relying on any single measure. We also place a strong emphasis on trading quality, especially in global markets. Execution matters and costs matter. Just as we use data and discipline in research, we apply the same rigor to how we trade, how orders are routed, how costs are measured, and how execution improves over time. Taking a big step back, over decades of active investing, the most consistent driver of long-term success has been diversification across regions, sectors, market caps, signals, factors like quality, value, and growth. That principle matters just as much today as it ever has. Be sure to like this video and subscribe to this channel to hear more from Vanguard's thought leaders.